Assalamualaikum and good day to madam. We are from Group 6 and will be presenting Chapter 3 and 4, which is Capital Structure.
So how to determine optimal capital structure? It is simply by calculating the mix of debt and equity that minimize the weighted average cost of capital, which is WACC, of a company while maximizing its market value.
Assalamualaikum, my name is NABILA binti AZMAN. Next, I will discuss factors affect capital structure and capital structure decision. There are 8 types of factors that affecting capital structure. The first one is size of the company. Small company may have to rely on the founder's money, but as they grow, they will be eligible for long-term financing because larger companies are considered less risky by investors. The next one is nature of business. If the business is a monopoly, it can go for debentures because their sales can give adequate profit to pay debts easily or pay dividends. The third one is the regularity of earning. A firm with large and stable income may incur more debt in its capital structure, unlike the one that is unstable. Businesses that have a proven business strategy that are either successful presently or have a clear path to sustain profitability. Earning stability is a proxy for business accuracy. Next is condition of the money market. Capital markets are always changing. They do not want to issue company shares during a bear market. They do it when there is a bull run. The financial market are constantly evolving. They do not want to issue firm shares during a weak market. Therefore, they only do it when the market is on the rise. The fifth effects is government policies. Government create the rules and framework in which business operate. When the regulation and structure of the government change, firms have to evaluate their business. When it comes to debenture, dividends, consolidations, interest and other issues, government regulatory agencies such as the RBI and SEBI often create rules. Next effects is cost of floating. This refers to costs incurred by a company in raising the funds from the market. To put it another way, flotation expenses include charges for issuing certificates and paying the underwriter as well as government fees and registration of the issuance. Next is debt-equity ratio. Equity is shareholder money and payment depends on profits being paid. High debts in the capital structure is risky and may be a problem in adverse time. There is a relationship between the debt to equity ratio and the level of risk connected with the company's capital structure. The ratio shows how much debt a firm has and how much financial leverage it has to conduct its operation. The last one is capital requirement. The larger amount of capital needed by the company, the more sources of financing that company should adopt to make sure their company can do well in their operation.
The next one is about capital structure decisions. A capital structure decisions is a decisions about firm's debt equity ratio. Every firm wants to choose a good capital structure to make sure their operation is going well. The first one is profitability. The capital structure that the company chooses must be able to help the company generate profit. Every company wants to maximize their profit to get a good financial result. The next one is solvency. It is about the potentials for the company to pay back their debt. Solvency ratio measures how well a company's cash flow can cover its long-term debt. Solvency ratios are a key metric for assessing the financial health of a company and can be used to determine the likelihood that a company will default on its debt. The third one is flexibility. The company can easily restructure its capital. And the last one is control. The best capital structure is able to control the finances of the company.
Financial distress. What is a financial distress? Financial distress occurs when a company's sales or profit are insufficient, preventing it from meeting or paying its financial commitment. For example, high fixed expenses, a high percentage of illiquid assets. There are various signs of financial distress. one of which is decrease in sales. It is because sales are used to pay for expenses. Having less cash available to pay for expenses has a visible financial impact. Nevertheless, the most worrisome aspect of decreasing in sales is that it typically implies a loss of customers, which is critical to any company. When the sales falls, revenue decreases as well. Furthermore, when the debtors take longer to pay their bills, this is an indicator of financial distress. It's because of the companies having a poor collection procedure, poor credit policies, or consumers who are not financially viable or creditworthy. There are various factors of business failure, one of which is obsolete product. When a corporation quits manufacturing, promoting, or supporting a sold or produced product, it is known as product obsolescence. Typewriter, for example, were a common sight in most offices until the 1980s. Following that, the personal computer with processing software was introduced. As a result, typewriters has become obsolete and Smith Corona Company filed bankruptcy in 1995. Furthermore, a lack of product variety is one of the leading causes of a business failure. This occurs when a corporation focuses solely on a particular product. For example, as the internet grew in popularity, other mobile phones began to realize the importance of data and mobile system in the future of communication. Nokia's mistake was they did not wish to lead the radical shift in the mobile system that Android and the software has brought about, and instead chose to focus only on their system, causing Nokia to be late in adapting to a new mobile network system. Liquidation is a method of resolving financial distress. Liquidation is the process of selling all of business assets, paying off its debts, distributing any residual assets to shareholders, and closing the company down as a legal entity. Furthermore, reorganization is a method of coping with the financial distress. When the corporation restructures its debt obligation rather than closing down, this is known as a reorganization. For example, China Eastern Airlines and Shanghai Airlines merged in 2009 at a time when both airlines were incurring losses and battling to stay afloat amid the global financial crisis. A merge is a business strategy in which two companies merge and function as one legal entity. This strategy is advantageous and has the potential to save both companies from bankruptcy.
Financial cost distress can be divided into three, which is first, bankruptcy cost. Second is indirect cost, and the last one is agency cost. Agency cost can be divided into two, which is agency cost of debt and agency cost of equity. The first one, bankruptcy costs. More debt lead to more risk the company should face to meet financial obligation to creditors. Highly levered firm is more in danger to a decrease in profitability. So, higher risk of bankruptcy is related to highly levered firm. Next is indirect cost. Low quality of production and services provided is due to several indirect costs of financial distress. It is because marketing research and other investment to spare cash were cut by conservative managers when financial distress occur. This decision could affect a firm's reputation. And the last one, agency cost, is usually a cost incurred by a firm since the problem related with the different interests of management. Sometimes it refers to a conflict of shareholders and the company managers. What is the consequences of integration of tax? Tax integrating is actually a concept of removing the difference in tax payable because of a choice in business or income structure. Dividend tax credit is the most common tax integration mechanism. A corporation has to pay income tax when they earn income. The rate of income is either a general rate or a low rate for the active business of CCPC below the threshold or the general rate. Besides, what is left of the income of a corporation to be paid out to shareholders as dividend is money that tax has already paid. The amount of dividend received is considered as income for the shareholders. The dividend would be taxed again at the shareholders' marginal tax if no integration mechanism existed. The dividend tax credit states that shareholders have the right to claim a tax credit on the amount of dividend paid that is almost equal to the amount of tax paid by the corporation. This is to ensure the same amount of tax on the income paid by shareholder is irrespective of whether it is earned personally or through a corporation. The lead of increment in the cost of debt of an organization is due to different interests of shareholders and debt holders, which make the agency cost of debt arise. For instance, debt suppliers like bondholders impose constraints on the use of their money when there is conflict between the debt holders and shareholders. In order to protect themselves from the ongoing conflict, the debt suppliers take initiative in form of higher interest rate, and this will lead to agency cost of debt. The priority given to dividend is one of such behavior. The management may give cash dividend to the shareholders, leaving very little to pay to the debt holders in order to please the shareholders. There is a requirement that the interest must be paid before dividend to avoid this situation.
Discuss agency cost of equity. What is agency cost? Agency cost is one of the agency problems that have faced by the companies. Agency cost is the type of company's internal expenses that comes from the action of an agent that acting on behalf of a principal. Agency cost is the cost of the conflict of interest that happen in the companies between stockholders and management. There are two types of agency costs that may happen in companies. The types of costs that can be happen in the companies are agency cost of debt and agency cost of equity. Agency cost of equity is the cost of corporate expenditure that benefits management, but it will cost to the stockholder. It also the expenses that arise from the need to monitor the management actions. Agency cost of equity also means that conflict of interest that arise between the management and the shareholders. It can be seen when the management make decision that is not the best interest for the company, and the shareholders see that the action that been taken will not increase the value of their shares. It will arise the agency cost of equity. For example, the management think that if they do the merger, it can be the best way for the business. But for the shareholders, they see that if they do the merger, it will not help to grow the business. The money that they want to spend on the merger could be better if they use it in paying dividends and investing the money in other areas. The costs that related in stopping the merger will be the agency cost of equity. There are some ways on how to minimize in the agency cost of equity. One way that can minimize agency cost of equity is by performance-based compensation. In this way, the company can do profit sharing to motivate the management to act better in the best interest of shareholders. Other than that, the ways that they can do to reduce agency cost of equity are by performing accurate accounting, set the limit on the business expenses, such as organize programs to the employee and traveling for the employee. In this way, the company can reduce the costs that related to the employee.
Assalamualaikum. My name is Muhammad IKHMAL bin Sadarhan. I will present about pecking order theory. This theory was first suggested by Donaldson in 1961 and later modified by Mears and Magluf in 1984. This theory provides guidance on how to start financing. The pecking order theory suggests that there is an order of preference for the firm of capital sources when funding is needed. In corporate finance, the pecking order theory assumes that the cost of financing increases with asymmetric information. Pecking order theory states that firms will prefer retained earnings to any other source of finance and then will choose debt and last is equity. Internal financing is the first choice in pecking order theory because there is no extra cost associated with using it. If a company uses only retained earnings for financings, there is no cost or debt or cost of equity to be accounted for. Debt financings come in second because of the interest payments associated with using debt capital. Whether the company decides to take up business loans or issue corporate bonds, they will have to pay some interest, making the cost of debt more than the non-existent cost of using retained earnings. Equity financing is the last in pecking order theory because it is the most expensive financing option. The cost of equity capital is higher than the cost of debt financings. The example is stock shares. Issuing share can indicate that a company's management believes that the shares are overvalued, a signal to investors that they might be in trouble and their share price might be about to drop. This is a case of asymmetric information, the core idea behind the pecking order theory. Asymmetric information is used to describe a situation between two parties in an economic transaction where one party has more or better information than the others. The pecking order theory relates to a company capital structure in that it helps explain why companies prefer to finance investment projects with internal financing first, debt second, and equity last.
Signaling hypothesis. What is signaling hypothesis? Dividend signaling is a theory that argues a company's announcement of increasing dividend payouts foreshadows a bright future. Increased dividend payout may suggest that a company's stock will do well in the future. According to the dividend signaling theory, firms that pay larger dividend are or should be more lucrative than those that pay smaller dividend. If an investor considers how much present payout predict future earning, this idea suggests that the signaling hypothesis can be contested. According to the dividend signaling hypothesis, when a firm announces a dividend raise, financial experts and investors interpret it as reflecting a strong future financial forecast for the company. Although many analysts are suspicious of the dividend signaling idea, there is some evidence that it is genuine. Increases in dividend distribution often indicate a favorable view of the company's financials and stock price in the future. A decline in dividend distribution might suggest that the company's financials are projected to suffer. According to the dividend signaling theory, corporations that pay largest dividend are more profitable. A firm with a long history of increasing its dividend each year might indicate to the market that its management and board of directors are optimistic about future earnings. A corporation that can pay a greater dividend can also make profit. For example, the Procter & Gamble Company's board of directors declared an increased quarterly dividend of $0.8698 per share on the company's common stock and Series A and Series B ESOP convertible Class A preferred stock. This dividend increase will mark the 65 consecutive year that PNG has increased its dividend and the 131 year that PNG has paid a dividend since its incorporation in 1890. As a result, a more outstanding dividend payment might indicate a company's ability to earn more profit.